Okay, 2.3. 2.3 is a very interesting topic because if you can get the foundation mentioned in this topic, you can basically finish the rest of the topic 2, even topic 3 actually. So let's do this. 2.2, we talk about double entry recording. What does that mean? So you know accounting is all about recording transactions, right? So, and in the transaction, it's very similar to your bank app. If you go into your bank app and you open up, you know, the transaction history, you will see a lot of information. One is how much money is going into our bank account. All right. Imagine if you have multiple bank accounts for different purposes, it will also tells you if it's going into bank account number 1 or bank account number 2. How much money is going into each of the bank account. It also tells you the source, which is where's this money coming from, right? So the source of the money, how much, and the destination of the cash. That's what accounting is all about, recording transactions and make sure that everything relevant is recorded onto accounting documents. All right, so have a look at this diagram. In accounting, to make it easier to follow, whenever money is going into something, we call it debit. And the accounts that the money is going out of, we call it credit. Alright? So listen. Debit means money going in to whatever account that is on debit column. Whatever account that is on debit column, it means money is going into it. And whatever account that is on credit column, it means money is going out of that account. Okay? Same thing with this. So the rest of topic 2 and topic 3 will be using the same principle. Okay? So, and this is how the double entry accounting looks like. We call it journal. So each of these is called an entry. Each of these lines is called an entry. And the journal entries is to record all of the entries, all of the accounts that are affected by one transaction. Okay, this is called a journal entries for one transaction. All of these entries is to represent one transaction. Have a look at this. Okay, it has a date, the year, the day that transaction happens, the accounts that are affected by that transaction, the debit and credit column. So now, if you already understand, credit means money is going out. If you see capital being on the credit column with this figure, what does it mean? Again, credit means money is going out. So this means 58,500 is going out of the capital account. And at this point, you already know that capital account means the owner of the business. Okay? So this much of money is going out of the owner's pocket money. That's it. That's the only meaning of this entry. This particular line here, that's what it means. It's on credit column, therefore this much is going out of the account. The question is, where is it going into? Right? So have a look at this. It's going into these 3 accounts. How do you know that? It's on debit column. So out of this much money, 40,000 is going into the bank account. Whose bank account is this? The business. All right? Remember that. The cash at bank account is here. So the owner this much is going out of the owner's account, and it's going into 40,000 is going into bank, 2,500 is going into computer equipment, and $16,000 is going into motorbike. And if you sum up these three numbers, you will see that these three numbers would sum up equally to this number. Right? So what is going on here? Is there a reason that the owner is the owner's pocket money is going out, and it's all going into these three accounts? This computer equipment belongs to the business. This motorbike also belongs to the business. So what's happening here is the owner is contributing to the business 40,000 in terms of cash. That's why it goes into cash at bank. And the owner also bought a computer for business purposes. It also buys the motorbike also for business purposes. And that's why we have these entries. Okay? So again, credit means going out. This much is going out of the owner and it's going into the cash at bank of the business. It's going into the computer for the business, and it's also going into the motorbike for the business. So technically, this entire journal entries recording one transaction, which is the owner is contributing to the business. And this particular owner is contributing three things: in cash, in computer, and a motorbike. As simple as that. Credit and debit. It might look a little bit strange to you because you've never seen these words, but it simply just means credit going out, debit, money going in. Okay? And as you can see, the last line in the journal entry, this one here, owner contributed assets. All of these are assets. Bank, current asset; computer, non-current asset; motorbike, non-current asset. So owner contributed assets to commence. Commence means to start up the business. And then memo. If you remember 2.1, we talk about memo is what is going on internally inside the business. And the owner contribution is internally. We don't involve customers. We don't involve suppliers. We don't take the loan from bank. Therefore, this one is called memo. And in order to know which memo is which, we have memo, the source document, and the number for that source document. So this is the typical format of a description of the journal entries, and we call this description a narration, which we will briefly mention in later. Okay, so this is called a narration. We have the description of the transaction, and also the source document and the number for the source document. So far so good?